Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. When too big is too big and when too small is our topic today. And what I think about this topic in terms of obviously position size. This is what I want to share with you in the upcoming minutes here. If you watch this on YouTube, by the way, then please subscribe to the YouTube channel, set a reminder for any upcoming webinars in the future. If you have any questions, feel free to ask them here right now in the Zoom webinar in the chat box. If you have any questions after you watch the recording or during the recording, please feel free to post them in the chat box below the video. Beside of that, I will also share some links here, respectively. Admirals will also share some links. You'll find all of these links in the description box. And so yeah, that's it on the quick introduction. Let me just now share my screen here with you, and then we have the topic right here. And by the way, that's something which is very important to me, by the way, here. Let me just say hello, traders. So this is the chat box, and this is where I'm active and where you can all ask your questions here now in the live event on Zoom. So yeah, what we want to discuss today is in fact a very, very interesting and very important topic because position size obviously plays a tremendous role when it comes to your overall performance or long-term profitability. You can be the best trader in the world if you don't know how to scale your business. In this case, if you do not know what's your advantage and when to trade big once the opportunity occurs, respectively, when to reduce your position size during a drawdown, but also when the setup is just not given, then it's obviously time here to reduce the position size. And what I want to do today, I want to share with you some thoughts here, not just on this matter in general, from several angles. We'll look at it also from a trading psychological perspective. But in addition to that, I'll also share a mathematical formula with you, a very easy one you can use in your trading. I share some insights on the formula itself, the history behind the formula, and yeah, then we take it from there. But before we start, first of all, we want to shine the light on Admirals, the broker who makes all this here possible, that you can witness these thoughts of mine, but also the thoughts from my dear colleagues, Paul, and also Marcus, who is every morning here for you with his morning show on the markets. Admirals, the broker who is standing behind this here. Currently, I'm seeing a rebranding taking place. So you probably have heard about Admiral before. It was Admiral Markets. Now it's Admirals. It's the same company. They are still a big player in the FX and CFD industry with over 8,000 financial industry instruments, not industry, instruments being offered, fully regulated by the FCA, by the SISEC, by the ASIC in Australia, and so on and so forth. And having probably one of the, if not the most competitive offerings when it comes to DAX trading. So I'm located in Berlin, in Germany. And here, usually in Germany in general, we refer to Admirals as the so-called DAX expert due to their very competitive offering when it comes to pricing here in terms of not just the spread, but also order execution speed, reliability, being capable of reaching out to your broker if you have any questions, and so on and so forth. But this is also true when it comes to FX trading. And beside of that, also that's a multi-asset broker offering investment opportunities and physical stocks for longer term opportunities. And now, after all this is already making Admirals a broker you should definitely consider. They are right now taking the next step, becoming a global financial service provider, offering a credit card, for example. And so, well, that means nothing more than you make money trading the markets, and then you can transfer the money within the wallet in the trader's room here from a trading account to the Visa card and then go shopping. or your wife shopping in this case, if you're a man like me. So in this case, there are further steps being planned here also when it comes to crypto and all this developments taking place there. So and in this context, Admiral Markets decided to go Admirals then and to make the next step and see some kind of facelifting. Let's put it that way. So if you have wondered, this is the main reason behind that. Any further information on this topic, admirals.com. Feel free to reach out also to the company itself. I will share the email address and everything at the end of this presentation, so to contact Admirals directly. And so yeah, that's it on the rebranding currently taking place. There's certainly also a global presence when it comes to social media activities. YouTube, I mentioned it already, but also on Instagram. So feel free to follow here Admirals on Instagram. And that brings us now directly to the first slide here, today's agenda in this context. And here in this context, asking the question on when too big is too big and when too small is too small in your trading and what's mentioned by that. What we first of all want to do is we want to have a quick glance here at the 3 columns of profitable trading. And then I want to give you also some thoughts on how these columns interact with each other. So probably you already know this. If not, also here, feel free to share it now with me right here in this event, but also share it below the YouTube video if you watch this on YouTube. If you want to hear more about this topic, we really love to hear your thoughts, not just on the webinar topics themselves, but also get input from your end on what to cover here in our presentations to make this, yeah, to some extent a unique experience for you probably. And this is what I want to also show then here in a quick overview on how these columns interact with each other. I want to then share with you this mathematical formula I was referring to at the beginning of the webinar, which I mentioned, the Cali formula, in fact. So it's a mathematical formula here, which goes back, in fact, to the world of gambling and was initially invented, or yeah, was found, let's put it that way, from a mathematician called Cali, then used, his knowledge here was used by a guy called Ed Thorpe. Ed Thorpe, you probably have heard about him. He's to some extent the mastermind, let's say, the mastermind behind the, no, he's not really the mastermind behind this. He was in fact the first guy who just discovered this formula for gambling purposes, and then went out to the casinos and crushed the casinos playing blackjack using the formula. But also in addition to that, he was the one who not just beat the dealer, which is one of his books, but he also beat the market then, saying after he was banned from the casinos, that he said, well, then I go to the biggest casino in the world, which he found on Wall Street, in fact, and then he traded the stock market there and found some inefficiencies here between the options / warrants market and then also stocks themselves, how they were priced, use this and to capitalize optimally on his identified edge here. He used the mathematical formula behind this, in fact. And so by the way, in this context, he used the formula, another formula he invented and never went out and make it public, but he used it to make tons of money, in fact. That was the so-called Black Scholes formula, the one where Myron Scholes and Official Black here received the Nobel Prize for, then in the 1990s, in fact. And the formula they found, or they invented here, and they received their Nobel Prize for, was the formula which Ed Thorpe already found earlier, but used to make money out of it. And so, yeah, this is a very fascinating guy, this Ed Thorpe, and this is already some history behind this. So a very fascinating topic. In fact, when it all comes down to Cali formula, it triggers a cascade here of thoughts around this topic at my end. And then we come here to the too big, too small aspect, and the necessary adaptations in the end, which we need to do to make here to then profit from this knowledge in our trading. And this is exactly the last point, and how we can use it in our trading, in fact. And now let's first of all here have a look at the 3 columns of profitable trading. So as you may have guessed, it's about risk and money management, it's about trading psychology, and it's about trading a strategy with an edge. So put it simply, these columns make profitable trading. If you don't have a clue about risk and money management, how to reduce your position size once you're in a drawdown, you can be the best trader in the world. You will bust your account. That's it. If you are not mentally stable, well, you can be the best risk manager in this context if you can't handle the emotional stress, which is naturally connected here to trading itself, because it's a game of humans played with each other. I mean, certainly you can now say, well, much of the trading right now is done via, for example, high frequency trading desks, algorithms, computers. But still, these computers are programmed here from human beings. So they have a natural tendency to include some kind of emotional component. And it also takes mental stability to let the system run. So I can tell you this from my personal experience several years ago, so that I traded an automated strategy, for example, and I had really trouble to let it run and not to directly intervene into the strategy. It can make sense if you share your knowledge, your trading related or market related knowledge here, and say, okay, I'm seeing some kind of massive extension here on the upside, which makes it likely that there will be a pull-in or a retracement, whatever, and then take at least partial profits, if not take out the position completely. So this can make sense. And if you can really make the strategy better that way, so the automated executed strategy, fair enough, but still this creates some mental instabilities. And this is something you have to take into account and you have to be aware of. And finally, certainly, if you are mentally stable, if you have a great risk money management plan, but the problem is that you do not have an edge, and you have to find your edge first of all, and really define it for you. Well, then you won't trade profitably. So you can be the best risk taker in the world. You can be mentally stable, say, I'm completely fine risking X amount of euros here in this trading spot. If my strategy does not work, and by the way, if someone wonders, does my strategy work or not? If the equity curve goes from the higher left of the chart down to the lower right, well, then it's obviously dropping and you're losing money. So your strategy or your strategy is not working / your edge is not given. And if you do not have an edge, well, you won't make any money. You can, again, mentally stable. You can see anything, every positive aspect of trading in general. Great. You can know, or you should be, or you are aware of not risking more than, let's say, 1% in your in each trade. By the way, this is a rule of thumb. In fact, you will see that in most of the cases, it doesn't make sense to just plainly risk 1% in your trading. But all of this can be set. You may have all the theoretical knowledge which is necessary to become an overall profitable trader, but if you do not know what the edge is you're trading on, and you do not have it, if you don't know what the edge is, well, then you don't have one. Simply as that. Well, then obviously you will have no chance to be profitable in trading. Simple as that. But now what I want to point out here, and which will then directly result in our in today's topic, in fact, is the interaction of these three columns with each other. So it seems at first glance, if you look at the chart before, that these columns stand independently and do not interact with each other. But in fact, and probably most of you already advanced here, most of you probably have already done some trading and traded some markets already. You know that these columns interact with each other. And we want to just put out one simple example here. We want to put out take out the risk money management column and the trading psychology column in this context. And so in this context, what we certainly know is that an inadequate position size affects naturally the mental stability in your trading. And you know what I'm talking about here. So once your position size is too big, you naturally tend to become very emotional during a trade. cut winning trade short, widen your stop. I don't want to take the loss here, or well, now the market has already moved, let's say 100 pips in my direction, even though the initial idea formulated a target of, let's say 200 pips or 200 points or $2 in case of a stock, whatever. And you're taking out the position after the market moved, let's say 50 cents in your direction or 50 points, because you say, well, the initial position size was so big that I have already made a tremendous amount in terms of performance on my overall account size. And so the problem with that is, obviously, if you cut your winning trade short, but then on the other hand, once the market is not moving in your direction and you take out the stop, for example, where you start to hope that the market will start to turn around, then the loss will be so big at the end of the day, will be so big that it takes away most of your overall account, in fact, and then eats all of your performance, if you ever had one, and even more than that. And overall, this is resulting, the mental instability which is caused here by the inadequate position size, is obviously one of the main reasons why many traders are in fact unprofitable in their overall trading. And so that, simply speaking, already illustrates how this plays with each other here in this context. Then we also know in this context that risk money management and trading with an edge obviously corresponds with each other. So that being said, brings us to today's topic, in fact, the right position size in our trading. So first of all, we could now point out that the right position size here is making sure two things. It should keep, or usually if it's the adequate position size, it should then keep potential drawdown small, and it should lead to an optimal growth of your equity curve. We could easily say that and keep it that way, but I'd like to extend this a little. So let's come back to the three columns here and now show how risk money management and trading with an edge here, with an overall edge in your trading, how these two columns play with each other. So just think about it that way. So you put in lots of work. So and it's in fact, it's hard work. So some of you probably, some of your friends probably, your family members, whoever, will probably laugh at you and saying, hey, I'm sorry, but you're sitting in front of a laptop or a computer and typing in some formulas, or you program your strategy, or you back tested it somehow, but I'm not really sure if this is work. So let's say your grandfather worked in a coal mine. No, this is work. So I'm sitting there and typing in some formulas. I'm not really sure if this is real work. And then if it works at the end, then, well, we could say, well, all this is like you're making money out of money. Is this really like work? So there's some philosophical questions which happen here. The interesting thing about this is, if you have this kind of conversation, or if you ever had it with some of your family members, good friends, who don't really think that you will make it as a trader, the naysayers, let's call them, you know how hard it is to keep on working, because you start to question yourself. Is this really worth my time? And this is only the social component here in this context. So we're not even talking about, I have ever taken a trade and then see the market moving in my direction and then eating up most of my floating gains in this context, because the market is now seeing kind of a corrective move or so. So, and the pain which is directly connected with this, or the pain you probably overcame after, let's say, having a losing trade on a Tuesday, but having a clear routine which tells you, I have to look up my trading results over the weekend. This is part of my routine to become better, to develop as a trader. Development as a trader is crucial to the overall long-term success. In fact, in your trading career, as you will have already found out, or will find out if you're about to start trading. And now imagine you think you overcame the pain which you somehow connected with this losing trade on a Tuesday, and then over the weekend you have to think about it once again. You have to question yourself. What did I do right? What did I do wrong? How can I avoid this in the future? Hopefully you will get anything positive out of this, but still it needs it needs some kind of stamina, in fact, resilience. So you have to really, you have to be willing to work on you and to question yourself every single second, every single moment, in fact, for every trade you take. This is not just true for the winning trades, but also for the losing trades, but also for the winning trades, the other way around. Just imagine you had a beautiful winning trade, and you just think, hey, I'm the greatest trader on the planet because I see my equity curve growing. And then in your after the emotions are set aside and you sit there and you reevaluate your trading, well, you just find out that you did a terrible mistake because you forgot to place your stop. So for me, this is somehow something which makes me smile, because I can't even imagine how it feels like enter a trade without having a stop, a predefined level where I know my hypothesis here is wrong and I take out the trade. So for me, this is something I just can't understand. But based on my experience I made over the years with many traders I talked to, also mentees, students who wanted to learn something in terms of trading from me, for example, they share their thoughts on this. And I'm just like, okay, this is kind of normal. So people sometimes just enter the market without having a stop here and a preset level where they say, I can't, it's not just I can't take the pain anymore, but it's more like, I'm like, let's say, I'm wrong on the trade. So this is the point where my hypothesis is not right anymore. So, and this can, yeah, this is the level where you have to just take out the trade. And just imagine that you initially enter the trade and then you're somehow distracted. You see not the spike on the downside, or you probably see it, but it's a quick rebid. But under normal circumstances, you would have been taken out of the position and then the market shoots higher. You see the massive gain at your end. You think you're the greatest trader, but you made a fundamental trading mistake, in fact. And realizing this in the end can cause tremendous pain in this context. Make long thing short. So the pain, which is directly connected to trading, naturally, losing trades, winning trades, the pain you take by not being understood from your parents, from your family members, from your wife, from your children, from whatever, whoever, this is pain. And if the moment occurs, once you have your edge, you identify it, and once you're on the right side of a trade, you want to get paid for the pain you were willing to take till this moment occurred. And so you can't really allow yourself, or let's put it simply, you just deserve better. You just deserve better in this case. So you don't deserve being too small in your position. You just deserve to be big, make money out of the trade, which pays you for the pain you took. And so this is what I mean in this context by the second point, in fact, which we want to focus on today. So this is now a long introduction and why I mentioned this. But usually when you read a book on trading, main focus, and it is also the usual way I try to attack this context or this topic on risk and money management. We talk about taking risks. We want to keep our risks small. We want to keep our potential losses small. And so this is what we should focus on. The rest will follow. So the winners will take care of themselves, we can also say. And so this is what mainly, or most of the time, we focus on. But the thing is that the second part shouldn't be underestimated. And that's one of the reasons why today's topic is also very fascinating, because it attacks the second point here and ignores the first one. The first moment. Still, we have to make some adaptations at the end, and then also take a look here at the adaptations we need to make, because we really can't look at it, and we will find out if we use this context, this formula, in a wrong way, you will see that rather sooner or later you will bust your account. And I will show you this, by the way, with a simple simulation in this context. So let's come now to this Cali criterion. So the possibility here we want to use to find the right position size, which helps us to get the optimal growth of our equity curve, given our known edge, respectively, the positive expectancy in our trading here. Is, well, where the Cali formula comes into play. And so this is exactly the question we answer here with the criterion, in fact. How can I create the optimal growth of my equity curve if I know certain parameters of my trading strategy? before now, I go here through the Cali Criterion. By the way, let me just do the following. I'll share the formula. You can just write it down in this context, and I guide you here through these variables in a few seconds. I have to make sure that my edge for today in my trading is given. So you probably have already seen it in the past, and I have to do it today once again. So I have to prepare my day in a certain way. I have to take several numbers which I need to see whether this play makes sense for me or doesn't. So let me just see. By the way, the shares I look at today are Plug after the earnings yesterday, currently gapping higher. Interesting, because Plug is a classic growth title, by the way. You probably have seen earlier that we've seen non-farm payrolls coming in better than expected. Better than expected makes it more likely that the Fed has now, and they can't avoid it anymore, to start talking about taper, at least, probably at the Jackson Hole meeting symposium at the end of the month here. And this is currently letting yields spiking higher. So if you've wondered where's the drop in gold, for example, coming from, the main reason here can be found in the aspect that yields are currently spiking higher. This is also something which is of interest for equities, by the way. So I've seen that the SPDR, so the ETF on the S&P 500, spiked higher, but I'm not really sure if now, if markets start to price in such a taper probability here, or higher likelihood that such a taper will be announced, that growth title, or especially equities in general, can continue to perform well. And so this is something I have to keep in mind here when talking about Plug. And now I have to also Moderna, obviously, and I have also Square on my agenda, even though Moderna, after its vertical move higher, potential drop now below 400, which is the key level of interest. And Square has seen some interesting price action yesterday, even though I'm not really sure if we can expect so much from today, because pre-market volume is very, very light, to be honest. But let's see. So yeah, as you can see, though, this is my structural edge. Every day I follow this routine over and over and over again. And so right now I'm here within the webinar, 3 minutes. You look at the clock right now, 3 minutes, we have the US market opening, and you might have said, okay, well, but you can't be really focused on the market opening. This is true. I know this. It's already part of my plan. So especially when it comes to Moderna, I need to wait for the opening to take place and then take it from there. But still, I'm capable to jump right into the action after I end the webinar here. So I really have no trouble then to see where we stand. I already formulated a game plan. So these are just parameters I will use then at the end to write it down in my playbook and evaluate my trading in this context. But this is something which is giving me my edge. So in fact, here now I have the edge. I see it in my account. I can see it in my equity curve. So it's growing. That means the edge is playing out. But still, the question I have to wonder all the time is, do I get enough money out of the market for my preparation and for all the work I put in? And this is exactly where then the Cali formula in this context starts to play a very important role, where these key components here come into play. So F in this context is the amount I'm willing to risk per trade here in percentage then. The POR is something I refer to as payoff ratio. I've heard that in the English trader lingo, a payoff ratio is not a well-known component. Also, probably English-speaking traders have heard about it in a different way. So I consider the payoff ratio the ratio of winning trades to losing trades in this context, or the average winning trade to the average losing trade, put it that way. Some of you probably refer to this as profit factor, even though I'm not really convinced whether profit factor is a fair way to put it, but it's the average winning trade to the average losing trade. So this gives us the payoff ratio, and obviously hit rate, loss rate, self-explaining. And so that means nothing more than here that if we assume we have a hit rate of our system. Let's say it's a mechanical system. We ran a back test, but also here it becomes clear you can also do this and use the formula based on your discretionary trading. So it could be that you say, I can't automate my strategy. In terms of my, for example, equities trading, this is not possible. I'm a 100% pure discretionary trading in terms of what I just wrote down and what I use in terms of taking my trading decisions here. But what I have is certainly a trading journal, and I know I can see the hit rate, I can see the loss rate, I can see the payoff ratio. And then I use these components here and use the formula to see at the end whether that works for me or not. So this underlines once again why especially having a trading journal is so important for an overall profitable trading, which is in fact probably the key to your profitability in your trading, and which is probably the most important aspect of your trading business in general. But let's come back to the formula. So if now let's assume we have a hit rate here for our system of, let's say, 40%, and on average, our average winning trade is 3 times as large as our average losing trade, then we have a payoff ratio obviously of 3, and then we can calculate here in this context our optimal position size here based on the Cali Criterion. So we have 40%, 0.4 minus 0.6 divided by 3. So, and this is obviously 0.4 minus 0.2 equals 0.2 equals 20%. So long thing short, risk 20% of your equity if your trading system is spitting out these key parameters of your profitability, which obviously it has a positive expectancy. We can see this here, but risking 20% per trade is a little larger, let's put it that way. So this is obviously showing why sometimes it needs, it not just needs adaptations, but also why mathematical trading approaches or mathematicians who turn trader sometimes need to talk to someone who has a little more experience, let's say, because they say, well, if the numbers give me here this 20% risk per trade, well, why shouldn't I take it? Because it's not considering the risk, especially if you're trading leverage products here, the risk of crushing your account, obviously. And if you have a bad run, for example, obviously, this bad run needs, first of all, adaptations in your overall position size. So the funny thing about the Cali Criterion is crushing the account does not mean you can't trade anymore, but it obviously reduces. If I lose 20% of my equity, then I have new input parameters I have to calculate my formula here based on. And the next time I'm not risking 20% anymore, but let's say just 16% or so. And this results in such an so-called asymptotic way, which makes it impossible, in fact, to crush your account, even though certainly once you pay commissions, for example, then obviously there's a point once you can't pay the commission anymore, you can't trade anymore. But this is, first of all, it's a long way to go. Second, the mental instabilities which will result out of a drawdown which exceeds 20% are already, based on my personal experience, heavy. And so this is something, if I have this already after my first trade, then I can guarantee you that there will be some second guesses or questions you ask yourself if it comes to executing the next time. And so now what I want to show you and guide you through here is, first of all, the adaptations we can make, and then I will show you why here obviously we increase the position size to not trade too small, because we want to get compensated for the pain we naturally face once we enter the trading business. On the other hand, we can see that too big will get too big if you overcome a certain point, in fact. And so let's now go even lower with the hit rate to 30% and say we have still the payoff ratio here of 3-to-1. So we use our formula now and say, okay, well, we have our risk we take, F, and then we have the hit rate, HR, and we subtract the losing rate, it's LR, and then the POR in this context. So 30%, 0.3 minus 0.3 divided by 3 brings us down to 7% per risk per trade we should take. And now suggest that we have a 10,000 euro trading account, 7% risk, even 7, not 20%, but 7% risk here is probably too big, even if you're a very aggressive trader. And in this context, also the emotional swings become a topic, and you can be the, again, most mentally stable trader. Still, if you lose 7% in one trade, this will do something with you. So, and you probably won't talk about it and in front of your friends, your wife, or whoever, but it will definitely result in some thoughts you will have once you lie down in your bed in the evening. So now the question comes, okay, what could be a solution in this context? So we want to use the formula in the future, but still, how can we adapt it in a way so that it becomes position size wise adequate for our trading in this context? And first of all, and that was something which, by the way, and this is one of the reasons I mentioned at Thorpe already at the beginning of this webinar, this is an approach which Thorpe brought up in the book Hedge Fund Market Wizards from Jack Schwager. You probably have heard about the Market Wizards series, the book series here, and Market Wizards in general. Market Wizards, New Market Wizards, Stock Market Wizards. And then I think it was around 2010, 2011, there was a next book which was published, and was Hedge Fund Market Wizards. After that, he also published Unknown Market Wizards, but that came later. So now we're talking about the Hedge Fund Market Wizards. And within this book, the first interview was with Ed Thorpe. And in this interview, Thorpe also brought up the Cali Criterion here in this context, shared his story and everything. So I highly recommend reading this book so you get a better idea of why I think that this is one of the probably most fascinating characters in the world of trading. And then he brought up the Cali Criterion, and he said how he could how he dampened the volatility. He how it was capable of reducing the volatility in the equity curve using Cali here by in fact 50%, while still getting 75% of the optimal capital growth. So that's something he's also a professor in mathematics, by the way. So that's not something to mention here in this context. And this is something which I pointed out here. So what's meant by this, let's take the 10,000 euro trading account, you cut it in half. So you're not trading a 10,000 euro account. That might be the account balance, but it's not the amount you're trading. So you think you have the account balance of 10,000, but you trade the account as if you only have 5,000 in your account. And then these 7%, which you planned here to risk, is still quite large, 350 euros in this context. We are not getting the optimal growth of our equity curve anymore based on the overall definition of the Cali Criterion and what it delivers. But in addition, but still we get 75% here of the optimal capital growth, while we reduce the overall volatility in the equity curve by 50%. And then I brought something up, which is also bringing us here in this context to a very interesting aspect. I again took the square root of these 3.5%. Personally, I have to say this is still quite large. And then I say I risk 1.8% risk, or I take 1.8 risk per trade in this context if I have these key parameters here in my trading, which is obviously directly connected to your overall edge you have in your trading, and which obviously is not the 1% you probably have heard about or read about in webinars / have read about in books, for example. And this is how a professional trader really thinks about how to get to the optimal position size and how to get a mathematical and proven construct here in terms of what to risk during his trading. And so now what I did here is, this is a small story I have to share here in this context. So I'm quite good known, let's say, well known in the German trading community. And over the years, one of the biggest book publishers came to me and asked whether I'm willing to write a book on trading. And I agreed, certainly. This is not of high value for you because the book is in German. And so it's, yeah, probably a little difficult here talking in an English-speaking webinar about a German book. But I want to share the story here behind this Monte Carlo simulator. So I wondered, before I started writing the book, I wondered, how can I make this quite dry topic, especially when it comes to risk and money management? It's about building a profitable trading strategy. So profitable trading, 3 columns: risk, money management, trading psychology, trading with an edge. Obviously, this plays a crucial role. And now the thing is still, I wanted to make sure that the reader has a chance to use the knowledge he acquires during reading the book here in the under practical umbrella, let's put it that way. So to work with it and to see how this works in the real world, in fact. And so the idea was born that I said, well, I built a website with such a Monte Carlo simulator where you can put in your trading key parameters around hit rate and loss rate and payoff ratio and so on and so forth, and then play around here. And so that's why I have this slide here, because now what I want to show you is to make this, to give this a sense. When I say too big, what is too big? So just imagine the following. Let me just go here to the website. I already opened it, and let me just I'm here. So it's in German, also in German as the book, and so I'm not really sure whether you can work with this or not. If you're interested, please leave a comment in the chat box, or we can also share it in the description box so that you can play around here with the Monte Carlo simulator yourself. But let's assume here, so this is a starting capital, the 10,000 euros we were referring to, and then we say we have here the number of trades we take. Let's say we analyze 500 trades. And then we have here our hit rate. Let's assume it's 40%. It's not 50%, it's 40%. And then we have Simulationsdurchläufe. This is like how many equity curves do we generate? So this is what you get to see here, and it's 15. So it's 15 different equity curves we generate here. It's so to explain it a little further, what you have here, Monte Carlo simulator. This is like we are using a so-called Bernoulli distribution in this context, and so what we simply speaking do is we say one. If we get a one here in our distribution, it's a winning trade. If we have a 0, it's a losing trade. And so you have different ways of combining ones and zeros, so winning and losing trades with each other. And in this context, then you obviously can see that there's this different equity curves which are naturally generated. And so here, this is the payoff ratio. I think this is self-explaining. And let's assume we have 3 to 1, and then we take 1% risk per trade. So that might get the job done right now. Or no, let's put it simply. No, let's work first of all with 1.8, 1% here. So this is huge, I'd say. So we start out with 10,000, and after 500 trades, the biggest gainer here on the upside is 600,000. So that's not too bad. It's a purely theoretical concept, but now the interesting thing comes into play. Imagine, or remember, the parameters I used here, 40% and 3 to 1, these are exactly the 20% here, which you get under Cali. So 0.2 means this is what Cali suggests to risk per trade. And then you have certain other parameters here, percentage or average performance, for example, which is quite impressive. You have the biggest drawdown, which is only 21% in this context. You have here the max number of winners in a row, max winning max row of losing trades, for example, average max drawdown, for example, and so on and so forth. Here's the expectancy of the trading. So in Germany, we call it the Erwartungswert, expected value. It's 0.6. So on average, you make 60 cents per trade per euro you risk on your trade. But this is not what we want to talk about. We want to talk about Cali today. And here we have 20%. So, well, if Cali tells us to risk 20%, let's risk 20%. Why not? That's not too bad. So you're the richest person in the world right now. I'm starting out with a 10,000 euro account. The only problem is you will never get there. Why? Well, because you can see here, the biggest max drawdown is 99.2%. The average here, max drawdown, is 96%. So which means you're losing nearly 96% of your equity if you're playing 100% Cali in this context. So it looks impressive, but again, you will never get there. And you can do this over and over again, and you will see it looks even more impressive now. So now you're the richest person by far. And even if you get divorced, no problem with that, because you will still be the richest person, and your wife will be the second, or no, you will both be, or husband, that doesn't matter. But again, it's 99.9%. It's 96.7%. You can play this and do this over and over and over and over again, and you will see you bust your account every time, risking 20%. So This is what Cali delivers in this context. And so now you see why these adaptations make sense and when too big is getting too big in this context. You get a theoretical idea behind us that, but still risking 1.8% is still a very, very solid performance you will receive. You will still have a massive drawdown over 30%. I think this is too much personally, but this is a personal risk preference. I stopped my trading with closing all positions once I reach 25% in my trading, and then start to think about what went wrong. Not even sure if I will ever get there. And every time over 30%, but still you get to some extent a performance which seems kind of realistic. And so this is bringing us then to the overall idea here behind today's, oh, I'm sorry, that wasn't right. So let me here. That brings us here to the final slide, to the summary for today's topic, because now you wonder probably, okay, what can I make out of this? So why is Cali of interest for me? Obviously, I mean, the performance speaks for itself. So no question about that. By the way, plug, I have it here right on my screen, just dropped 28. So done for the day. This is not of interest for me anymore. So I think I will then focus on Moderna. Yeah, that seems very likely. So you can already see, so I'm in the webinar, but I already know how to adopt based on the information I already acquired here beforehand, before I started the webinar. But let's come back to the summary. So why is this impressive? Why is this of use? Why is it useful for us to consider this formula? So I mean, you have now an idea on how to calculate the optimal position size in your trading. You see that in the basic version, without adaptations, you bust your account. So all in all, you might say, well, this doesn't make sense to use it in my trading. Then it makes perfect sense. And you will see why. Because it's not just that you find a mathematical, based on your input parameters, your trading parameters, a position size, which is of use for you. But the thing is, so unfortunately, this is one of the later points, but the thing is to get these numbers, and this is something I talk about right now. You will see the last bullet point here covering this. To get these numbers, hit rate, loss rate, payoff ratio, you need to know what you're doing. You need to test your strategy first. You have to think about a strategy. It's not just you jump into the water and try to swim, or put it differently, open the trading account, start trading. But you have to think about what you want to trade, and then wonder, is this what I thought about here making sense? Do I have an edge? Program it, test it, think about it again, adopt accordingly, optimize to some extent, backtest what you thought about. You get parameters like the hit rate, you get parameters like the loss rate, you get the payoff ratio, and you can work with this. You can then formulate the optimal position size based on Cali. But even if you don't want to use Cali and the suggested position size in your trading, you have started and have an edge compared to the other market participants. Most of them, I would say 90%, probably even more, just don't start that way. They just jump into the water and try to swim. They don't have an edge. They don't know what they're doing. They just trade. And this is something to keep in mind in this context. Wait, let me just see. Gosh, good. Okay, perfect. So this is something to keep in mind why Cali itself, thinking about this, is in fact very, very helpful in your trading in general, beside the fact that the historical story behind the Cali Criterion here is one of the probably most fascinating stories ever, and you will just enjoy, you will just love the story to read about at Thorpe here in this context. Still, let's come back to the second bullet point. Using Cali here when finding your position size does not mean you get a better performance. You have seen it yourself. We played with the simulator. We crushed the account 3 times in a row. And we can do this over and over again. We will crush the account every time. Especially when you trade leverage products and we push the envelope here too far. Or we trade basic Cali, we don't even need to push the envelope too far. The massive drawdowns will naturally occur. Respectively, we will kill our account. This is something we have to keep in mind. Potential solution, I provided it here. You're trading one part of your trading capital aggressively, or you reduce it for your overall account. You can also go the more conservative way, say, I have, let's say, 10% of my equity, let's say 1,000 euros, 10,000 euro account, 10%. So at 10,000 euros is only 9,000. Then I trade conservatively, depending on whatever strategy I'm trading. 10% I'm trading with Cali. I'm trading with half Cali. I'm trading with probably I'm kind of adaptation with the square root we work, and then try to create some kind of overperformance. And still, now we come to the last point. I already mentioned it. Cali perfectly shows that you need to have a trading strategy, and that you have to know what you're doing. You have to know that you're trading with a positive expectancy. Most of the traders talking about psychological problems, mental instabilities, it's a technical problem. It's not a problem within them, because the most of the time, these instabilities result out of the fact that they just don't know what they're doing. And the missing puzzle piece here, let's put it that way, is just, if I give you a strategy which works, or if you trade a strategy which works and you know that it works, this mental instability will just fade away. It just will go away, and you will be mentally stable in your trading, because you know what you're doing in your trading. And this is what this mental stability in fact comes down to. I mean, then certainly other aspects which are not technical anymore come into play, and you have to keep an eye on. For example, I heard a story about a very, very successful businessman who then started out and wanted to trade. And he was profitable. So he made money trading the markets. And what happened was that after some progress he made and the account grew to a certain amount, he busted the account. And he did this over and over again. And then he went to a psychologist, and he was a known trading psychologist here in Germany, by the way. And so it's a story I heard directly from him, without mentioning any names. It was just to illustrate this, what the real true psychological problem is in your trading. And they found out that during his childhood, his father was also a very successful businessman. So as his father, he as his son was successful in his business. But still, there was some problems connected to that, because the success his father had as a business person resulted in the father destroying the family. So he didn't take care of the family anymore. And that was something which was how do we say that? It was like it was within him. So there was a direct connection to success. And when he saw that his trading saw success, he feared that he would now kill his family life that way. And that was the reason why he then busted the account and overcome this obstacle. This is a true psychological aspect. But most of the problems you face from a psychological perspective, or you think these are psychological obstacles you have in your trading, are only given by the fact that you don't know what you're doing. And Cali is in fact, can be the reason why you want to find your edge in your trading, formulate a strategy and take it from there. Because then you have to first of all think about what you want to trade. You have to think about all your positive, or about the expectancy of what you're planning to do. You can see it, you can visualize it, and then take it from there. So, and you have a complete different relationship to your trading strategy and the trust within the strategy. And this is something where, beside the position size, looking at Cali makes perfect sense. And so that brings us to the end of the webinar, but this brings us also to the next webinar, and I'll be your moderator next time too, on the recent Robinhood IPO. We will look at it. And here we want to answer a very interesting question. Probably it's the end of the meme stock hype. We want to shine a light on the IPO, why it was very attractive to also trade it. We want to shine a light on who is Robinhood. We want to also give some thoughts on IPO trading in general, not just on Robinhood, or Robinhood related, but also why IPO trading could be of high interest. And then we also want to give an idea on how this could end the meme stock boom. Yeah, right now, GME, AMC, and so on and so forth. 2 p.m. London, 11th of August, 2021. We will have a look at this. Check your webinar, check your inbox for the webinar. If you already registered, you can register on the website, admirals.com. In fact, that's it, around next Wednesday. So I really look forward to it. Here are the contact details. I promised at the beginning of this webinar, if you have any questions around Admirals, check out or chat directly with them. And one world, one broker. So in this context here, this is one of the main reasons why you should probably give Admirals definitely a deeper look. Right now, they also expanded their business to Jordan in this context, also are regulated there now. And well, regulated, that brings us to the risk disclaimer. That's what we have to show here at the end. So I hope you enjoyed the webinar. Again, if you have any questions, feel free to ask them. If you watch this on YouTube, check out the chance here to ask the questions in the chat box below. Subscribe to the YouTube channel. And I just look forward to next Wednesday. So 11th of August, Robinhood IPO. And now have a nice weekend. Yeah, have a nice weekend. Enjoy yourself. Talk to you next week. Happy trading. Watch your stops. See you. Bye-bye.